Hey Stockhouse, it's Bruce Campbell. It's time for another edition of Markets in Motion. We've seen a lot of things happening in the last week, but in particular, I want to focus again on the volatility of gold. And if we look at the gold volatility index, the GVZ, you can see here that it's spiked up and it actually went above this 30 level. We haven't seen too many instances of this happening in the past, and it's actually fairly significant. We've now started to see it calm down a little bit here, but we want to keep our eye on this. We don't have the same data, but when we look at silver volatility, same thing. It spiked way up over the 100 level, again showing us that there's some fairly significant volatility that's happened. One thing I just want to point out is even before we started to see the gyration in gold up and down, while it was still in that up phase, we were starting to see this volatility really start to climb and pick up. This is really interesting data that I thought was important given what we've seen here, and this comes from Sentiment Trader. And what it's looking at is when we've seen these spikes in gold volatility, what happens to returns for gold going forward. And you can see here, this is really interesting information. 1 week later, it's kind of a mix. You don't really know where things are headed. But 2 weeks, 1 month, looking out 6 months and a year, you can see that the win rate has been 100%. There's only 3 other instances in past where this has happened. So it is important to recognize that there's not a lot of data here. When we look at silver, same type of information here. You can see that, going out a couple of weeks, you can see the numbers. Going out 6 months and a year, you can see the numbers again. There's only a limited amount of data here, so you need to be careful with that, but it certainly looks very positive. This is what I thought was really interesting. When we look at NASDAQ returns for the subsequent period, it's also positive 100% of the time. Again, only 3 other instances in the past where that's been the case. Just want to focus a little bit on our early warning indicator. So this is for the S&P 500. You can see that our early warning indicator has now turned negative. And so something we want to be aware of. We don't do anything position-wise with the portfolios when that happens. We just want to be aware of it. That's got to be in the back of our mind on what's happening. But when we switch gears and look at the S&P 500 equal weight, so looking at the RSP ETF, you can see that it's actually positive and accelerating. So what's that telling us? It looks like the Mag 7 starting to slow, and we see the other 493 starting to accelerate. And if we look at the earnings trends that we've seen as far as the rate of growth in the earnings, you can see that the Mag 7 starting to decelerate the rate of growth. So it's gone from being up 57% a couple of years ago to only being up 20%. Only being up 20% is still fantastic growth, but the market's always looking at the rate of change. If we look at the equal weight to the cap weight, you can again see that it's really starting to break out here, and that equal weight, so the 493, is where we're starting to see the momentum. And then if you look at the mega cap, here you can see that it's actually broken the early warning indicator, and it should come as no surprise then that the Mag 7 as a group is actually negative on the year so far. And then if we look at the GDX, the gold miners, you can see that it's positive, giving us no inclination yet that there's anything happening from our early warning indicator. That's it this week. Have a great week out there, everyone, and happy trading.